Are you living in Nigeria and looking to explore ways to make extra income? Maybe because of the rising cost of living in the country, or just to have some extra money in hand to do nice things for yourself. Have you also seen people talk about making money from trading forex on social media and showing off nice things? You might be interested, but also feel a bit lost with all the information out there. Maybe you're asking yourself, where do I even begin? Or can I really make money from trading forex? If these questions are on your mind, you are not alone. In this video, we will break down the basics of forex trading. We will explain the process in simple terms and give you practical steps to get started. Before we get into details of how to trade, let's first talk about what forex actually is. Simply put, forex trading is when you buy and sell currencies on the foreign exchange markets with the goal of making a profit. Now, here's something interesting to know. The forex market is the biggest financial market in the world, with a daily trading volume of about 6.6 trillion US dollars. Plus, it opens 24 hours a day, 5 days a week, because it operates across different time zones around the globe. So how does forex work? In summary, you buy one country's currency and sell another, hoping that the currency you bought will go up in value compared to the one you sold. If it does, you can sell it later at a higher price and make some money from the difference. Let's use the Naira as an example. Let's say you want to trade the Naira against the US dollar. And let's say right now, one US dollar is worth 1,000 Naira. If you believe the Naira will weaken against the dollar, you might decide to buy 1,000 US dollar at the exchange rate, costing you about 1,000,000 Naira. If your prediction is correct and the Naira does weaken, let's say it drops to 1,200 Naira per dollar, you can then sell your 1,000 US dollars for 1.2 million Naira, earning a profit of 200,000 Naira. Unlike other financial markets, such as the stock market, which is based on the performance of individual companies, the forex market is influenced by various economic factors. These factors include central bank decisions, inflation rates, release of economic data, political events such as elections, and geopolitical tension, all of which can impact the value of a country's currency. It is also important to understand some key terms and concepts to avoid feeling overwhelmed as a newcomer to forex trading. First, let's talk about currency pairs or instruments. In forex, currencies are always traded in pairs, which means you are simultaneously buying one currency and selling another. For instance, if you are looking to trade the US dollar against the British pound, this will be the currency pair. Here, the pound is the base currency and the dollar is the quote currency. Buying this pair simply means that you believe the pound will strengthen against the dollar. If it does, you will make a profit from the difference. Now let's talk about the different types of currency pairs. Currency pairs are categorized into 3 groups. We have the majors, we have the minors, and we also have the exotics. Major pairs are the most frequently traded currency pairs in the forex market, involving currencies from the world's largest and most stable economies paired against the US dollar. Examples include the Euro USD and British Pound USD. Major pairs have the highest liquidity, which means they can be bought or sold quickly with minimal impact on their price. High liquidity typically results in tighter spreads, making these pairs more cost-effective to trade. Minor pairs, also known as cross-currency pairs, involve currencies from major economies but excluding the US dollar. Examples of minor pair include the Euro Japanese yen, the British pound Swiss franc. While they do not have the same level of liquidity as major pairs, they still offer very good trading opportunities. The spreads are usually wider than those of major pairs, but they can be an attractive option for traders looking for diversity. Exotic pairs consist of one major currency paired with a currency from an emerging or smaller economy. These pairs are usually less traded, leading to lower liquidity and higher volatility. Because of this, they often have wider spreads, making them riskier and more challenging to trade, especially for beginners. Next up, we have pips. A pip, or point in percentage, is the smallest price movement in a currency pair. For most currency pairs, 1 pip equals 0.0001. So let's assume the British pound USD pair moves from 1.4562 to 1.4566. It has increased by 4 pips. These movements can determine your profit or your loss. So if you buy the British pound USD pair at 1.4562 and it rises to 1.4570, your trade has gained 8 pips. If you decide to sell at this point, you have made a profit. Now that you know what pips are, let's move on to understanding bid and ask prices. When buying a currency from a broker, you will see two prices, the bid and the ask price. The ask price, which is slightly higher, is the price at which the broker sells the instrument, while the bid price is the current market value of the instrument and what you can sell it for. The difference between these two prices is known as the spread. Spread is basically what the broker charges you for the instrument. So if the British pound USD is quoted at 1.31828, 1.31829, the spread is 1.1 pips. So let's move on to lot size. A lot size refers to the amount of currency you are trading. It's basically a package of currency units. A standard lot is 100,000 units, a mini lot is 10,000 units, and a micro lot is 1,000 units. The lot size you choose determines the scale of your trade, so a larger lot size can amplify both your profits and losses. Speaking of amplification, let's also talk about leverage. Leverage basically allows you to control a large portion with a relatively small amount of capital. It is often represented as a ratio, such as 50-1 or 100-1, and the leverage you are given for your trade mostly depends on your broker. For instance, with a 50-1 leverage, you can control $50 worth of currency for every $1 you have in your account. So if you have $200 and you use a 50-1 leverage, you could actually trade up to $10,000 worth of currency. However, it is very important to note that leverage is a double-edged sword. Yes, it can magnify your gains, but it can also amplify your losses. So use it carefully. Now that you have a grasp of leverage, let's look at the types of market trends you will encounter in forex trading. Forex markets typically move in three directions. We have the upward direction, we have the downward direction, and we have the sideways direction. An upward trend or bullish market indicates that prices are rising, or they are expected to rise. Traders buy currencies anticipating their value will increase, allowing them to sell later at a higher price. For example, if you believe the euro will strengthen against the US dollar, you would buy the euro USD in a bullish market. On the flip side, a bearish market is when prices are falling or are expected to fall. Traders sell currencies in this type of market, expecting their values to decrease, with the plan to buy back at a lower price later. So if you expect the Japanese yen to weaken against the Swiss franc, you would sell the currency pair in a bearish market. Lastly, there's the sideways or ranging market. This occurs when prices move within an horizontal range, showing no clear trend in either direction. So in case you are worried about, not knowing which direction the market is going, many brokers offer a tool called Live Market Sentiment to help you with that. This tool shows the percentage of traders who are bullish or bearish on a particular instrument, helping you make more informed trading decisions. Finally, let's talk about the two main types of trades in Forex. We have the long and the short trades. A long trade is when you buy a currency, expecting its price to go up so you can sell it for a profit. So let's say you buy 1,000 units of Euro USD when the price is at 1.1000. If the price goes up to 1.1050 and you sell the 1,000 units, you would make a profit of $50 due to that increase. A short trade, on the other hand, is when you sell a currency, expecting its price to go down so you can buy it back at a lower price. For example, if you sell 1,000 units of the British pound USD at 1.3000 and you buy it back when the price drops to 1.2950, you would make a $50 profit from that trade due to the drop in price of the currency pair. And the good thing is that You don't need to worry about doing the calculations yourself. Most brokers offer a profit and loss calculator that automatically figures out how much you stand to gain or lose on a trade, either long or short. But it is still important to understand how these calculations work so you can make smarter trading decisions. Think about the early days of COVID as a real life example of a long trade. If you had bought the yen USD pair before the pandemic hit, you could have sold it later at a much higher price. Now, for a short trade, imagine just before the Brexit announcement, you had sold the British pound USD pair before the news. You would have been able to buy it back later for a lot less. Now, you might be wondering if Forex is legal in Nigeria and if there are any specific bodies or organizations regulating it. The good news is, yes, Forex is legal in Nigeria, but unfortunately, there is no specific regulatory body in Nigeria that oversees it. Unlike other countries where Forex brokers are licensed and regulated, it is not the same in Nigeria. Instead, the Central Bank of Nigeria indirectly influences the Forex market through policies aimed at stabilizing the Naira. While these policies impact the Forex market, they don't offer the same level of protection that you would enjoy if you were trading in another country. So what does this mean for you as a trader in Nigeria? First off, since brokers are not licensed in Nigeria, you will need to use international brokers to trade. While many of these brokers are regulated by reputable international bodies, the lack of local regulation brings certain disadvantages. One major disadvantage is the potential risk of falling victim to fraudulent brokers. Without a Nigerian regulatory body to oversee Forex activities, there is little or no protection for you as a trader in Nigeria. This means if something goes wrong, like maybe a broker disappears with your funds, you might have limited options in getting it back. And again, the absence of regulation can lead to less transparency. For example, regulated brokers in other countries are required to do things like, keep clients' funds separate from their own, offer negative balance protection, and a number of other measures to safeguard the traders. These protections might not be guaranteed with international brokers, especially if they are not regulated by a top-tier authority. To navigate these risks, it is important to do a thorough research before choosing a broker. Make sure any international broker you choose is regulated by a well-known authority, such as the FCA, that's the Financial Conduct Authority in the UK, or the Cyprus Security and Exchange Commission. This way you can trade with more confidence, knowing that your broker is held to a high standard of safety and reliability. So when it comes to picking a Forex broker in Nigeria, what exactly should you be looking for? Since Forex trading isn't regulated here, you will need to be extra careful. As I said, make sure the broker you choose is regulated by a well-known international body. This gives you several levels of securities, even though there is no local oversight. Next thing you want to do is to check out the currency pairs they offer. A broker with a wide range of options gives you more opportunities to trade. Then, you need to think about the minimum deposits needed to open an account with the broker. It is important to find a broker whose minimum deposit fits within your budget. You also want to ensure they offer convenient and secure payments and withdrawal methods, preferably one that will allow you to deposit and withdraw in Naira or to and from your local bank. Another thing to consider is their fee structure. Find out if they charge a spread, if they charge a commission, or any other fees for trading with them. Finally, make sure they have reliable customer support. You want a broker that is easy to reach and can help you out if you have any issues or questions. Once you have picked a broker, the next step is to fund your account so that you can start trading. The minimum deposit actually varies depending on the broker and the type of account you choose. A standard account is usually the go-to for most traders, and it is a great option if you are just starting out. So depending on your broker, the minimum deposit could be as low as $10. How much you actually need to deposit also depends on the trading strategy and your goals. So if you plan to trade a lot or aim for bigger returns, you might want to consider putting in more capital to handle larger trades. But please keep it in mind, while a bigger investment can lead to higher profits, it also comes with the risk of bigger losses too. So it is important to find a balance that works for you. Okay, now that you have an idea of how much it takes to open a trading account, you are probably wondering, how much can I make in Forex markets? Well, that actually depends on a few factors. First off, your skill level plays a big role. That's why it is super important to learn as much as you can before making your first trade. The more knowledgeable you are, the better your chances of success. Another key factor is how much money you are trading with. Let's be serious. You cannot invest $10 or its naira equivalent and expect to make 100,000 profits in a day or two. The more you invest, the higher your potential profits. But of course, with higher stakes comes higher risks. Market conditions also play a big impact on your earnings. The forex market is highly volatile, so things can change quickly due to economic events, political news, and other factors. These fluctuations can either work in your favor or work against you. So it's important to stay informed and be prepared for anything. Now, trading forex is a 24-hour opportunity, 5 days a week. But just because the market is always open doesn't mean every moment is ideal for trading. Some periods are more active, and knowing when to trade can make all the difference. The forex market is divided into 4 main trading sessions: the Tokyo, London, New York, and Sydney sessions. Each of these sessions corresponds to a major financial center in the world. So let's break down when these sessions occur in Nigerian time and which ones offer the best trading opportunities. First up is the Tokyo session. This is the first major market to open each day, and it's a good time to trade if you're interested in currency pairs that involve the Japanese yen. The Tokyo market is mostly active from 9 a.m. to 6 p.m. Tokyo time, which is around 1 a.m. to 10 a.m. in Nigeria. Next, we have the London session, which is one of the busiest trading sessions. The London trading session is particularly important because it overlaps with the Tokyo session for a few hours, offering you much more opportunities. This session runs from 8 a.m. to 9 p.m. London time, which is 9 a.m. to 6 p.m. in Nigeria. Then we have the New York session, which is another very highly active period, especially when it overlaps with the London session. If you are trading major currency pairs that include the US dollar, this is when you should be most active. The New York session operates from 8 a.m. to 5 p.m. New York time, which is around 2 p.m. to 11 p.m. in Nigeria. So when exactly is the best time to trade in Nigeria? The optimal trading hours are usually between 2 p.m. and 7 p.m. when the London and New York sessions overlap, creating the most active market conditions. Another good window is between 8 a.m. and 10 p.m. during the overlap between the Tokyo and London sessions. So now that you have the basic understanding of forex trading and the markets, what steps should you take to actually become a forex trader in Nigeria? Becoming a successful forex trader takes a bit of preparation, practice, and patience. Even though you have a handle on the basics, there's always more to learn. Forex trading can be tricky, so staying informed is key. Read books, check out articles, and watch educational videos. A great place to start is the My Trading Land University channel on YouTube. It offers easy to follow lessons on forex trading. The more you know, the better your chances of making smarter trading decisions. Next, you will need to choose a broker that fits your needs. Not all brokers are the same, so you want to consider things like their reputation, the trading platform they use, the fees they charge, amongst other things. A good broker can make a big difference in your trading experience, so take your time to find the right one. Before you put real money on the line, it is a good idea to test the waters with a demo account. A demo account lets you trade with virtual money, so you can practice what you have learned without any risk. It's a great way to get comfortable with how trading works and to test out your strategies. This practice will give you confidence and help you avoid costly mistakes when you start trading for real. Once you feel ready and have practiced enough, it's time to open a live trading account. This is where you will be using real money. So start small. only invest what you are comfortable with, and never risk more than you can actually afford to lose. Stick to your strategy and keep an eye out on the market. Remember, Forex trading is a journey that takes time. Be patient, keep learning, and gradually build your skills. With dedication and practice, you will be on your way to becoming a successful Forex trader. It's important to remember that even though you've learned a lot and practiced, it does not mean you will start making profit right away. The Forex market can be unpredictable, and even experienced traders face challenges. That's why it is crucial to use some simple risk management strategies to help you protect your money and increase your chances of being profitable over time. So one effective strategy is to stay on top of economic news. This is really important because, as mentioned earlier, economic events can significantly impact the forex market. Things like exchange rates, employment records, political events can cause currency prices to move. So by tracking this news, you can anticipate market movements and make more informed decisions. Also, before you jump into any trade, it is essential to study the currency pair you are interested in. Yes, tracking economic news is part of what is called fundamental analysis. This helps you understand the broader economic factors influencing a currency. But you also want to do some technical analysis, which means studying the price charts and patterns of a currency pair. By combining these two approaches, you will have a clearer picture of what might happen and be better prepared to trade. Another key strategy is setting a stop loss order before making your trade. Think of a stop loss as your safety net. It is a tool that automatically exits your trade if the price drops to a certain level. This way, if the market moves against you, you won't lose more than you are comfortable with. It's just like having a fail-safe in place to protect your investments. Finally, be careful with leverage. Leverage allows you to control a larger position with a smaller amount of money, which can lead to bigger profits, but it can also lead to bigger losses. So while high leverage might seem tempting, it is extremely risky. If the market doesn't move in your favor, you could end up losing a lot more than you planned to. That is why it is often better to use low leverage, especially when you are just starting out. It helps you manage your risk and keeps your losses small. Okay, now let's talk about your mindset, because it is just as important as your strategy or your knowledge when it comes to forex trading. The market can be unpredictable and prices can change in the blink of an eye. It's easy to panic or get caught up in the excitement, but staying calm and keeping your emotions in check is crucial. One of the biggest challenges you will face is the fear of missing out, which is often driven by greed. You might see other traders making quick profits and feel the urge to jump in, thinking you will catch the same wave. But this can be a very dangerous mindset. Just because others are profiting doesn't mean you automatically do the same. Before you enter any trade, it is essential to do your own analysis. Take the time to understand the instruments you are trading so you don't end up regretting a rushed decision. Now, let's say you give in to the fear of missing out and ended up losing some money. Well, it happens and it's a part of the learning process of trading. But the key here is to not overtrade in an attempt to quickly recover those losses. It's natural to want to make up for lost ground, but jumping back in without a clear plan can lead to even bigger losses. Instead, take a step back, analyze what went wrong, and learn from the experience. Trading isn't about chasing every opportunity. It's about making smart, calculated decisions. Then probably the most important mindset to have is setting realistic expectations for profits. You might hear stories of traders who made millions in a short time, but what you don't hear about are the long periods of no profits or the significant losses they faced along the way. It's easy to get caught up in the excitement and the need to get rich quickly. But for your own peace of mind, it is better to set achievable goals. Focus on steady and consistent progress rather than trying to hit it big overnight. A realistic target, coupled with a solid strategy, will serve you far better in the long run. So we have come to the end of this video, and if you found it helpful, Please give us a like and consider subscribing to this channel. That way, you won't miss out on any of our future content about forex trading in Nigeria. Thanks for watching, and until next time, happy trading.